Hey everyone, Anand here. Welcome back. I hope you liked my last video where I covered LVI's fin graphs, which you can use to analyze company financials in a visual way. If you haven't watched that video, you can watch it here. Once I had some understanding of reading about a company's financials, the next question I had was, how do I go about selecting a stock for potential investment? There are over 7,000 listed stocks in America alone, and suddenly I felt hopeless and lost. I wanted to be able to quickly assess a stock against a few set parameters and see if they are worth my time for a deeper dive. While building LVI, hence I came up with the idea of simple key insights. Simple key insights are a list of 10 key parameters against which you run any stock and see how many pass. If they do not pass at least 4 or 5 of them, they may not be worth our time for a deeper dive. Remember, we are not trying to select, but the game is to reject as many as we can and then end up with some for our deeper dives. In this video, I am going to explain to you what these simple key insights are and how we can use them as a quick screener. Well, let's jump right in. Once you have pulled up a stock in LVI, you can access the simple key insights by clicking on the tab Key Insights. As you can see, there is this default tab for simple insights and there is another tab for detailed insights. We will cover the detailed insights in my upcoming videos. As soon as you pull up this page, you quickly see how many checks out of 10 the stock has passed. Next, the stock is evaluated for its growth using 3 metrics, then the financial health using 2 metrics, and then how is the current valuation compared to its historical valuation based on 2 metrics, and finally the profitability and management is evaluated based on another 3 metrics. That makes it a total of 10 parameters to quickly see how the business under consideration is. Let us see what those key metrics are and how Alphabet stock does against those. Starting with growth rates. Under growth rates, the first one is if the revenue has grown in the last 5 years. Similarly, the next one is if the net income has grown in the last 5 years. And the next one is if the company has been able to grow its free cash flow in the last 5 years. The good news is that the Alphabet passes all 3 checks under growth and hence receives thumbs up for all 3. We can conclude that Alphabet has been able to grow its revenue, the net income and the free cash flow in the last 5 years. So we can say that the company has been able to grow overall in the last 5 years. At this time, we do not want to get into much details like the real growth numbers and all. The idea is to quickly see if the stock has been growing in the last 5 years. After growth rates, we will check how the debt situation of the company is. How financially healthy is the company? No matter how fast a company is growing, for long-term success, we must make sure that the company is not under a lot of debt. Under this, we check if the current ratio is adequate for the company. Now, what is the current ratio? Let me try to explain this in the most simple way. In the simplest way, it is a ratio to quickly measure if a company is able to meet its short-term obligations or commitments. By the short term, we refer all financial obligations due within the next 1 year. It is obvious that the company can only use that part of the assets for this purpose which is already in the form of cash or can be converted into cash within the next 1 year. Such assets are called current assets. Likewise, all the liabilities that are due within the next 1 year are called current liabilities. Once we divide the current asset by the current liabilities, we get the current ratio. Simply put, we are trying to see if the company has enough short-term assets, that is current assets, to meet its short-term obligations, that is current liabilities. A ratio below 1 would indicate that the current assets are lesser in value than the current liabilities. In other words, the company doesn't have enough current assets to meet its short-term obligations should a need arise. Similarly, A ratio above 2 would indicate the company has double the current assets it would need to meet its short-term obligations and would be considered safe. As you can see in the screen, LVI evaluates if the current ratio is better than 1.5 and gives a thumbs up to Alphabet. Having covered that the company is able to meet its short-term obligations, now it is necessary to see if the company can meet its long-term obligations as well. How about the company's long-term debts? The companies which are cash-producing machines are generally in a position to tackle their upcoming debt commitments. Here, LVI calculates the average of the last 5 years of free cash flow for the company and sees if the total long-term debt can be paid off in less than 5 years. As you can see, Google passes this test as well. However, let's see this in action. We can pull up Google's balance sheet to find out its long-term debt as of right now. And that is about $11.5 billion. We copy it and then paste it over this Google sheet. Now let's head over to Google's cash flow statement and go to the bottom where the free cash flows are listed. We then copy these 5 free cash flows and paste it in the Google sheet to find the average free cash flow in the last 5 years. As we can see, if we divide the total debt by average free cash flow in the last 5 years, then we get 0.21 years. That means Google will be able to pay all its long-term debt using the average of the last 5 years of free cash flow in less than a year. And Google gets a thumbs up on this as well. Overall, we can conclude that Google can pay both its short-term as well as long-term obligations and hence can be considered financially healthy and strong. Now LVI checks the current valuation of the stock. It does this in 2 ways. And the first check is current P/E ratio is not extreme, that is, it is not greater than 40 and is lower than the average price to earning ratio of the recent past. And the second check is that current price to free cash flow ratio is not extreme, that is, it is not greater than 40 and is lower than the average price to free cash flow ratio of the recent past. But first, let's see what is the P/E ratio. The formula for P/E ratio is share price divided by earning per share or EPS. Let us calculate this for the Alphabet. The current share price of Google at the time of recording is $171.58. And the earning per share or EPS for Google for the trailing 12 months is $6.52. So, the P/E ratio for the trailing 12 months should be 26.32. Now, what does that mean? In simple terms, it means that for every single dollar of Google's earnings, the market is currently ready to pay $26.32. A higher multiple shows people are ready to pay a higher price to buy the stock because they are bullish about the future prospects of the company and hence the demand is high. And similarly, a lower PE multiple shows people are not so bullish about the future prospects of the company and hence the demand is low. Historically, lower PE ratios have been associated with potentially higher returns in the future because when the market perception changes positively for the company, the multiple re-rating occurs and the stock price can rise, resulting in higher returns for investors who bought at a lower PE ratio. Conversely, higher PE ratios can lead to lower future returns. When a stock's P/E ratio is high, there is a greater risk that the stock price already reflects high expectations for future growth. If the company fails to meet these lofty expectations or if market sentiment shifts, the multiple de-rating or the reverse will happen and the stock price may decline, leading to lower returns for investors who bought at a high PE ratio. Additionally, as a rule, LVI tends to be cautious when the PE ratio goes above certain thresholds like 40. In my opinion, this level of multiple often signals excessive optimism and may warrant further scrutiny. In simple insights, LVI will compare the current PE multiple of the company to the average of its last 5 years PE multiple. If it is lower than the average PE of the last 5 years, then that means it may be trading at a discount to its historical valuations. In the case of Google, the current PE is lower than the average of the last 5 years of PE as calculated by LVI, and hence the thumbs up. Next, a similar calculation is done then for price to free cash flow ratio, and Google gets a thumbs down there because the current price to free cash flow ratio is higher than the average price for the last 5 years. Next, LVI will check 3 metrics that are related to the profitability and the management effectiveness of the company. First, LVI checks if the business earns an above average return on the capital that is employed in the business. Let's try to quickly break it down. Now, what is an average return on the capital? In simple terms, a return on capital of 10% means that if you are running a business and have put $100 million of capital into it, then you will likely make a profit of $10 million. If the return on capital increases to 20%, then the profit would also increase to $20 million. Since we would always want higher profits, a higher return on capital is always welcome. We will get into the details of the formula for return on capital employed when we are covering it under detailed key insights. Charlie Munger has said that over time, a stock's return is unlikely to be much better than the return of the business it represents. For example, if a business earns 6% on capital over 40 years, holding it for that time will result in a similar return even if it was originally purchased at a discount. However, if a business earns 18% on capital over 20 to 30 years, the result will be better even if the price paid seems high. So basically, if you buy a business at a reasonable price, then over long periods of time, your investment returns would likely match the return on capital employed by the business. Now, the long-term return of the benchmark S&P 500 index has been in the range of 8 to 10%. So for my individual stocks, I want this to be a notch better, and hence, in the simple insight, I have assumed 15% as the average return on capital employed. When I checked online, the data released by none other than the Dean of Valuations, Professor Damodaran, as of January 2024 also shows it to be around 15%. But for now, as you can see, Google passes this check as the return on capital employed in the last 10 years has been in excess of 15%. The next quality metrics is if the gross margin of the business has been above average. Let me explain to you what gross margin is in a simple way. What does it mean to have a gross margin of 40%? It simply means that if you sell your product or service for say $10, and if your gross profit margin is 40%, then your gross profit is $4. Where did the rest of $10 go? Well, $6 was the direct cost to produce the product or the service you sold. In other words, since you are in the business of selling a t-shirt for $10, then in this case, the cost of the material and the labor for the t-shirt is $6, and hence your gross profit is $4, giving you a gross profit margin of 40%. Now the next question is, what is an acceptable average gross margin for a company? LVI consider this to be 45%. Why? Again, when I checked online, the data released by Professor Damodaran as of January 2024 shows it to be around 37%, while I also found this page where it says the average gross margin for a company in the S&P 500 is just about 45%. So I think 45% is reasonable then. And you can see that Google passes this check as well. Next, LVI checks if the management has been buying back its own shares. Now, what is share buyback? In simpler terms, a stock buyback is when a company buys back its own stock or shares from the open market or directly from shareholders, which can lead to a decrease in the number of shares outstanding. Now, why does a company buy back its own shares? It does so to return capital to shareholders, to signal confidence in the company's prospects, and to also control the share dilution that happens because of stock-based compensation offered to its employees. It also boosts the earning per share of the company by decreasing the number of shares count, which may boost the share price as well. Share buybacks should be carried out when the company shares are trading at a discount, and this could be a great use of the company's capital. As you can see, Google also passes this test, signaling that the management has been buying back its share recently, which is a good sign. All in all, the simple key insight page quickly shows that Google passes 9 out of 10 pre-checks and confirms it to be good business. Now, should we invest in this business at this time? Not really. Passing the checks is not an approval for investment. It is just the beginning for more research, and it indicates that we are going in the right direction and we should next take a deeper dive into Google. For illustration purposes, let's take another wonderful business, ULTA Beauty, and see how many checks it passes. As we can see, ULTA also passed 9 out of 10 checks. In fact, the only check that it does not pass is the gross margin check. Being in the retail industry, its gross margin is generally lower. In ULTA's case, it is generally between 39 to 40%, which is lower than our benchmark of 45%. We can also quickly conclude that it passes both the checks for valuation, signaling the stock may be undervalued compared to historical price multiples. So the question I would be asking at this stage is, do I want to invest in a company that has been growing, seems to be debt-free in the short as well as long term, also seems to be undervalued compared to historical price multiples, also earns more than 15% return on capital, and the management has also been buying back shares lately? Looks promising so far. At least I can convince myself that it deserves my time and attention. So I should now get ready to take a deeper look at the business of ULTA along with its financials before thinking about buying its stocks. Moving over to At&T, we can quickly see that it has only passed 5 checks. Revenue and free cash flow of the company have not grown in the last 5 years, so obviously this has not been a growing company. It fails both the checks under financial health, signaling it to be a leveraged business. If we are too concerned about that, we should further look into the debt situation of the company. It passes both the checks for valuation, signaling the stock may be undervalued compared to historical price multiples. And finally, we can see the company has not been able to earn a 15% return on capital in the past. At this stage, the question that I should ask myself is, do I want to invest in a company that has not been able to grow, seems to be carrying a lot of debt, and doesn't earn a 15% return on capital but seems to be undervalued? If my answer is affirmative, I should go to the next step and do further analysis. If I don't want to invest in such a company, I should probably not waste my time anymore and move on to the next opportunity. The question is this a foolproof way? Certainly not. There are chances we will miss good company at times, but remember, that's not the game we are playing. We are simply trying to maximize our chances for winning stocks, and hence missing is okay. Also remember that there is no penalty for missing, but the reward waits for the right selection. And we are trying to build a process so we can maximize our chances to be on the right side of the trade. That wraps up this video. I hope you found it informative. Feel free to leave any questions you have in the comments section below. And if you would like to be part of my journey to learn, invest and learn, then be sure to subscribe to my channel. See you in the next video.